Sin stocks get a bad rap, but that just ends up making them more attractive for the rest of us by virtue of lower valuations and higher yields. Want to know about a 5-star Sin stock that offers up a market-smashing yield near 6% right now? Then you have to check out today's video.
He is a best-selling author.
30-year-old Jason Fieber has a plan.
This guy retired at only 33 years old.
I don't know if I know too many people that have accomplished something like that.
He's really kind of a guru when it comes to passive income.
Before I get into today's content, please give us a big thumbs up if you find value in our videos. Helps us to get the word out and grow the channel, and I'd really appreciate it. I want to tell you about a high-quality stock that pays big, growing, reliable dividends. These growing dividends are funded by growing profit because this business is providing millions of customers with high-margin tobacco products. Now, one could argue the ethical nature of a tobacco business. The questionable morality of a business model is where the term sin stock comes from. But I'm not here to judge either way. Buy a stock or do not buy a stock. Buy a product or do not buy a product. It's up to you. However, I will say that a sin stock like this one tends to have a narrow shareholder base, which provides for more opportunity via the lower valuation and higher yield. I personally invested in stocks just like this one on my way to going from below broke at age 27 to financially free at 33. Best of all, the stock looks undervalued right now. Price is what you pay, but value is what you get. Why is that important? Because buying a dividend growth stock when it's undervalued should provide for a higher yield, greater long-term total return potential, and reduced risk. With this in mind, I want to share with you an opportunity I recently came across in shares of Philip Morris International Inc., which appear to be trading at a significant discount today. Philip Morris International Inc., stock ticker PM, is the world's largest publicly traded tobacco company engaged in the manufacture and marketing of tobacco and related products. With corporate roots dating back to 1847, Philip Morris International is now a $123 billion by market cap global giant. Fiscal year 2019 revenue can be broken down geographically as follows: European Union 34%, South and Southeast Asia 20%, Middle East and Africa 15%, East Asia and Australia 11%, Eastern Europe 10%, and Latin America and Canada 10%. The company's global market share is an estimated 28%, excluding China and the United States. Their huge market share is predicated largely on the strength and ubiquity of their Marlboro brand, the #1 cigarette brand in the world. This brand alone contributed over 35% of their total cigarette sales volume for last year. This is one of the kings of so-called sin stocks. The core business model, tobacco, is one of the most lucrative out there, commanding huge margins off of products that are addictive by nature. That nature has historically helped the business in times of trouble, such as the current pandemic crisis we're dealing with right now. People are typically more likely to smoke during times of economic stress. However, this is also one of the most taxed and regulated business models out there. That makes it less appealing and rewarding for investors than it'd otherwise be. Then there's the fact that some people consider the business model unethical. This keeps the investor base somewhat narrow, which also tends to keep the valuation low. And that low valuation can lead to a high yield, as well as the opportunity to reinvest one big dividend after another into an unloved stock. The stock yields a mouth-watering 5.8% right now. That's about 3 times higher than the broader market's yield. It's also 70 basis points higher than the stock's own 5-year average yield. This giant yield comes on top of a respectable 5-year dividend growth rate of 3.4%, with Philip Morris International increasing its dividend for 12 consecutive years. That dividend growth streak is as long as it possibly could be, as the company was spun off by former parent company Altria Group Inc. in 2008. Philip Morris International has been paying a growing dividend since it became an independent company. And while the payout ratio at 100% looks unsustainable, one of the more important accounting aspects to remember here is that the company reports earnings in US dollar terms. While it's based in the United States, it earns profit everywhere else. Thus, currency exchange rates can cause the business to suffer large swings in GAAP earnings. Free cash flow does more comfortably cover the dividend than GAAP earnings, although I will say that the overall dividend coverage is tight and will limit the size of dividend raises over the next few years or so. Looking at business growth, the company increased its revenue from $27.208 billion in fiscal year 2010 to $29.805 billion in fiscal year 2019, which is a compound annual growth rate of 1.02%. That's slightly disappointing. However, we have to keep in mind that tobacco usage globally is in secular decline. This means volumes are regularly dropping. Fortunately, due to demand being price inelastic, the company can slowly increase the price on its products to offset volume reduction. In addition, because the business is a cash cow with little need for ongoing reinvestment, the company can buy back stock and drive excess bottom line growth. For perspective, the company reduced its outstanding share count by approximately 15% over the last 10 years. Earnings per share expanded from $3.92 to $4.61 over this period, which is a compound annual growth rate of 1.82%. Again, not super impressive, but I think the USD reporting does throw things off somewhat. If we look at free cash flow on a per share basis, that compounded at a rate closer to 2.5% over the last decade. And I think that's pretty close to the company's true growth profile. Looking forward, CFRA believes that Philip Morris International will compound its earnings per share at an annual rate of 3% over the next 3 years. This would be right in line with what I just noted about free cash flow per share growth. Philip Morris International's future largely hinges on the success of its new IQOS product, which is a unique heat-not-burn device designed to mimic traditional cigarettes while also reducing risk. IQOS is being rolled out globally, and it received FDA approval for sale in the US in April 2019. Former parent Altria Group Inc. has the exclusive licensing agreement to market and sell this product in the United States. This product is a growth avenue in a business that's facing secular decline in its traditional offerings. To give you context, cigarette shipment volume was down by 4.5% for fiscal year 2019. However, heated tobacco unit shipment volume was up by a whopping 44.2% for the same year to 59.7 billion units. I think CFRA has an accurate call on near-term earnings per share growth, which will likely translate to similar dividend growth, albeit slightly lower due to the high payout ratio. Moving over to the balance sheet, the company has a relatively solid financial position. While long-term debt-to-equity ratio is not applicable because of negative common equity, an interest coverage ratio of over 13 indicates no issues whatsoever with leverage. Profitability, as you might expect, is quite robust. After all, they specialize in a high-margin, addictive product. Over the last 5 years, the firm has averaged annual net margin of 24.65%, but return on equity is not applicable due to negative equity. This is a low-growth, cash cow business that's perfect for income investors who like their dividends about as big as they come. And with scale, strong brand recognition, and extremely high barriers to entry, competitive advantages protect the business and that dividend. Of course, there are risks to consider. Regulation, litigation, and competition are omnipresent risks in every industry. I will say that litigation is the largest of the three in my view. Regulation actually works to the company's advantage in some ways. That's because there are strong restrictions on the industry, particularly as it relates to advertising. This creates barriers to entry, limiting competition. It also reduces the need to spend on advertising. An entrenched oligopoly has the ability to engage in rational pricing. However, plain packaging is an example of regulation that works against the business model, and litigation is a constant sore spot in this industry. The dollar is a risk here because of the aforementioned accounting idiosyncrasy. Lastly, any acceleration in traditional cigarette volume declines, especially if paired with less adoption of the IQOS system, would hurt profitability. With these risks known, I still think this is a compelling long-term investment idea. That's particularly so with the valuation being so attractive. The stock is trading hands for a price-to-earnings ratio of 17.1. This is far less than the broader market's earnings multiple. It's also well off of the stock's own 5-year average PE ratio of 20.6. We can also see that the current price-to-cash flow ratio of 14.7 is disconnected from its 3-year average of 16.2, and the yield, as noted earlier, is materially higher than its own recent historical average. I valued shares using a dividend discount model analysis. I factored in an 8% discount rate to account for the high yield and a long-term dividend growth rate of 3%. This dividend growth rate is right in line with the long-term free cash flow per share growth rate. It also matches CFRA's near-term earnings per share growth rate, and it's lower than the company's own 5-year dividend growth rate. It's likely that dividend growth over the next year or two will be muted, but their new IQOS has an incredible growth runway in front of it, and the company's need for investment is also coming down. Thus, I think the long-term dividend growth rate will average out nicely. The dividend discount model analysis gives me a fair value of $96.41. The reason I use a dividend discount model analysis is because a business is ultimately equal to the sum of all the future cash flow it can provide. The dividend discount model analysis is a tailored version of the discounted cash flow model analysis, as it simply substitutes dividends and dividend growth for cash flow growth. It then discounts those future dividends back to the present day to account for the time value of money, since $1 tomorrow is not worth the same amount as $1 today. I find it to be a fairly accurate way to value dividend growth stocks. Morningstar rates PM as a 5-star stock with a fair value estimate of $98. CFRA rates PM as a 5-star strong buy with a 12-month target price of $95. We have a tight consensus. Averaging the three numbers out gives us a final valuation of $96.47, which would indicate the stock is possibly 21% undervalued. Here's the bottom line, guys. Philip Morris International Inc. is a rare stock commanding a 5-star rating from both Morningstar and CFRA. With an exciting growth product rolling out globally, a near 6% yield, a clear commitment to the dividend, and the potential that shares are 21% undervalued, dividend growth investors okay with a sin stock should take a serious look at this one. Thanks so much for watching. I hope you enjoyed today's video. Give us a like if you did, and let us know in the comments what you think about this stock. Please make sure to subscribe to the channel and ring that notification bell so you don't miss out on new content. Also, take a look at the description box below for some important links, including the link to my personal stock portfolio. This 6-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It allowed me to retire in my early 30s. I've made my portfolio entirely accessible over at Patreon, and I also post alerts there whenever I buy or sell a stock. I put my money where my mouth is and am often invested in the same high-quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who've been profiting from many of the same exact stocks that I own. So if you think this is something that you could benefit from as well, check the link in the description to see my portfolio and start getting my buy and sell alerts. See you next time.